So bank-owned life insurance, or B.O.L.I, is a tax-efficient method that offsets employee benefit costs. The bank purchases and owns an insurance policy on an executive life and is the beneficiary. Cash surrender values grow tax-free, providing the bank with monthly bookable income. Upon the executive death, tax-free death benefits are paid to the bank. B.O.L.I is used as a tax-efficient method for offsetting the cost of an employee benefit program. Historically, B.O.L.I was often combined with a new executive benefit plan for senior executives. However, in more recent years, many banks have added B.O.L.I in order to offset existing employee benefit expenses. There are three types of B.O.L.I products currently offered to banks. General account. So this is the oldest form and still the most common product in the market today. When banks make an investment in a general account product, the deposit becomes part of the general account of the insurance carrier. Most insurance carriers primarily invest in real estate and bonds. The carrier does not provide specific detail on where they're investing the B.O.L.I proceeds. Rather, they provide some detail of the general account holdings of the carrier. The product has a current crediting rate, which can be changed from time to time by the carrier, as well as a guaranteed minimum crediting rate that it cannot fall below. 2, you have the separate account. So under this approach, the carrier segregates the holdings from their general account into bank-eligible investments that are managed by well-known fund managers. The fund managers provide detailed reporting of the assets within the portfolio. The crediting rate is determined by the carrier using a yield to worst ratio. However, there is no guaranteed minimum crediting rate. A stable value insurance rider can be purchased in order to smooth out the market-to-market performance and provide downside protection. Thirdly, you have hybrid account. So this approach is a combination of the benefits of the both two prior approaches, which provide both a current and guaranteed crediting rate of a general account product with the transparency of a separate account product. It should be noted that both separate and hybrid product are not subject to creditors of the insurance carrier, providing yet another level of protection to the bank. So, your next question is probably, how does B.O.L.I work? Well, a bank purchases the life insurance with either a single premium or a series of annual premiums on a select group of key employees and/or bank directors. The bank is the owner and beneficiary, although many banks opt to share a portion of the insurance proceeds with the participants. The tax-adjusted cash value growth within a B.O.L.I policy produces a return greater than the opportunity cost of what the bank would have made in an alternative investment if it had not purchased B.O.L.I. From a compliance standpoint, the B.O.L.I gains are used to offset the cost of the employee benefit programs. Typical B.O.L.I products are single premium and immediately accretive to earnings, creating an instant positive spread over the cost of funds used to purchase B.O.L.I. The accounting for B.O.L.I is governed by FASB Technical Bulletin 85-4 and should be recorded on the balance sheet as an other asset. The increase in cash surrender or contract value during a specific period, as well as the final net insurance proceeds at maturity, should be recorded as other income. Now, B.O.L.I is a long-term asset when properly implemented and administered. It offers the bank a highly rated investment option with a significant tax advantage versus other bank permissible investments. So let's talk about the advantages of B.O.L.I. B.O.L.I is a tax-favored asset with returns that typically exceed after-tax returns of more traditional bank investments such as muni funds, mortgage-backed securities, and 5 to 10-year treasuries by 150 to 300 basis points. Cash values grow tax-deferred, tax-free if held till death. Death benefits are tax-free. The ability to efficiently generate gains to offset costs associated with benefit programs. The products are institutionally priced and designed specifically for financial buyers. They are immediately accretive to earnings. The risks that are well within standard business risks is in the bank investments portfolio. There's well-defined guidance on permissible usage by regulatory authorities. There are no surrender charges. It diversifies investment portfolios and gives the ability to immediately increase ROE and ROA. Disadvantages of B.O.L.I. Let's talk about that. So B.O.L.I is considered to be a long-term illiquid asset, not because of its lack of liquidity, as it can be surrendered at any time without policy charges. However, if a B.O.L.I contract is surrendered by the bank, the gains within the policy become taxable, as well as a 10% IRS penalty on the gain, similar to surrendering an IRA prior to 59.5. If the policy is held to the death of each insured, the gain becomes part of the tax-free death benefit and no taxes occur. Assuming the bank is in a profitable position, it's unlikely that they would wish to pay taxes on the gain unless the liquidity of the asset is needed. In practice, the greatest concern for most banks is the credit quality of the B.O.L.I carrier. Most carriers in the market are of the highest quality. However, that can change over time. The second concern is the competitiveness of the crediting rate in comparison to the market. To address these concerns, the bank can either surrender the policy and pay taxes, or execute an IRC Section 1035 exchange of the policy to another carrier. A 1035 exchange is similar to a tax-free IRA rollover. Generally, most 1035 exchanges occur after the 10th policy year as to avoid carrier penalties. So that's going to be it for today, folks. To get an evaluation of your own, schedule an appointment with the link in the description. So also, ladies and gentlemen, wipe ass, work in progress every day and see success. And remember, folks, when people challenge you, they don't challenge you to challenge you, but they challenge you to challenge you. Accept the challenge. Salute.